Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about DocuSign. Why DocuSign is an attractive investment? We're going to talk about what DocuSign is, that it's much more than just an e-signature platform. We're going to talk about some of its positive aspects such as its operating margins and its growth rates. Then we're going to talk about the one thing that investors need to be concerned about, which could be its valuation. So let's just dig in. So it's quite interesting that in 2021, a lot of the tech names have really not done very well. So many of the names in tech that did quite well in 2020 and were seen as COVID beneficiaries have really struggled. So I put up here some names. These are not direct peers, but I put up Chewy, Pinterest, and Zoom. So, I mean, these stocks haven't really done that amazingly well in 2021, but the outlier here is DocuSign, that's up 36% so far this year. So, I mean, it's really interesting to me because it's many of these names, I don't think that it's really that they performed very well last year and they're not going to be performing very well going ahead, but the market has been a bit kind of like fickle at the moment. But when it comes to DocuSign, investors are saying, okay, no matter what, the revenue growth rates remain really strong. So you can see here that the company is still expected to grow in fiscal 22 at 41% year over year. Now, DocuSign's fiscal year is already 2022. So, but you can see here as it's comping and it goes into Q2, or when it reports Q2 2022, which is in a few weeks time, you can see that they're growing at 40%. So even though they obviously did quite well in 2020 like last year, as they're growing in 2021, they're doing really well here. So they have a very strong growth rate, and that's because they've been quite successful in moving beyond e-signatures. So the way they say it is that, okay, e-signature is half of our total addressable market, but the other half of our products that really take the journey of the customer through the whole contract lifecycle management is the other half. So e-signature is one aspect, but there's much more to us than that, just that. And in the back end, it's really trying to be a cloud offering. It wants to be seen as similar to, let's say, a Salesforce or as Workday. It's really a cloud platform that controls the whole cycle and tracks the whole cycle of the contract. So the way that the contract is written up, and you being able to search within that contract for clauses, and adding a lot more towards the regulation side, so that DocuSign can really target many different verticals. So I think that that's really interesting, and you can see here, this is really, it puts the facts out there. So it's net dollar retention last quarter was up, and it was 125%. So this is a 600 basis point expansion from the same time last year, and you can see over the past 8 quarters the expansion in its net dollar retention. So I mean, this is really like, if a picture speaks 1,000 words, it's really, it tells you everything you need to know. It's not just about COVID. This is a company that's doing well despite us lapping the COVID period right now. This is translated into very strong operating margins. So you can see that the operating margins I put here, these are I've just taken the yearly parts. I've removed the quarterly just to take away some of the noise. But you can see here that over time, fiscal 19, fiscal 20, fiscal 21, operating margin went from 2, 5, 12, and they're guiding to be at 17% for this year. So there's just a very consistent growth on the top line, and there's just nicely consistent growth and margin expansion on the bottom line. Now, for all this, investors are paying 29 times sales. So, okay, investors say, okay, that's really pricey. And I mean, it's not cheap. I'm not going to pretend it's cheap. But if you look at something like Axana's priced at is another productivity platform, and that's priced at 40 times sales. Zscaler is a cloud security platform, and that's priced at approximately 50 times sales. So at Zoom, the multiple has compressed, and it's right now is at 28 times sales. So I mean, paying 29 times sales for a SaaS business that is growing on the top and profitable on the bottom, I think it's reasonable. I'm not going to pretend that it's a cheaply valued stock. I'm a big fan of buying into cheaply valued stocks, but you're paying here for a lot of visibility, and you're paying here to know that the company is going to be growing at 40%, possibly coming into a high 30% next year. So you want to know that you have a lot of growth rate. You're going to pay 29 times sales quite easily for a company like this. So you're not going to get a lot of negative surprises along the way, and that's really what you're paying for. So I don't think it's too expensive. Having said all this, if you want to know what kind of stocks I'm into, find out which type of investments I'm more inclined towards, don't forget to check out my marketplace called Deep Value Returns. I'll tell you the stocks I own. I'm looking for types of investments that are, the outlook is not as good, but the valuation, I believe, more than compensates for that. I like investments where there's something kind of that the market isn't quite understanding right now, with the idea that if you take an investment right now and then, in a year's time or so, the market comes around to that news story, and you're obviously able to offload that investment at a higher price. So yeah, don't forget to check out my marketplace. You can do a totally free trial to see if it suits you when you come in, and if you like it, you stick around, and if you don't, you unsubscribe. And you won't be charged anything. See you soon.